The secular can be down, but the cyclical can be up. The secular could be up, but the cyclical could be down before trends back up again. So just be aware of that. Getting back into our macro weather model. So this is a section where we unpack the macro weather model for those of you who want some more insight into that model. It's a very important, powerful tool. Of the two tools that we use to help our clients stay on the right side of market risk, it's our global macro risk matrix that now casts a top-down market regime. It's what you should be doing as an investor to stay on the right side of market risk. And the macro weather model gives us confidence to say this current market regime should extend itself for at least the next 3 months. If you're trying to look out the next 6, 7, 8 months, you need to apply fundamental research to get to that point. And that's obviously what this presentation is designed to do, is to give you confidence to create confidence or take away confidence in the sustainability of the current regime. And if we're taking away confidence in the sustainability of the current regime, then what is the next regime we're going to head into? It's the current trade. It's speaking in buy side lingo. What's the current trade? What's the next trade? What's the current trade? What's the next trade? I don't give a damn about the 2 trades from now. It's the current trade, the next trade. If you can constantly do that well as an investor, I don't care if you're buy side or retail, that's how you consistently compound returns. If you're worried about 2 trades from now, 2 careers from now, you're going to lose your seat, you're going to lose your money, you're going to lose your client's capital. And that's why we don't do that kind of stuff here at 42 Macro. So getting into the macro weather model, we already unpacked this on slide 10. So let's just get into how the model actually works. So just kind of summarizing in these back tests here. This is the evolution of the stock market signal over time, evolution of the bond market signal over time. This is the evolution of those back tests. So if you use the macro weather model signal in a similar vein in terms of taking down, increasing or decreasing your exposure to the particular asset class based on the parameters of this back test here, you can see that it's a great tool for managing risk in the stock market, not the best tool for managing risk in the bond market looking backwards, because we had a 40-year bond market bull where rates went to zero. Can't build a risk management process that's better than just being buy and hold bonds 40 years. But we obviously think looking forward in time, it's going to be quite important, as you can see here, in terms of avoiding that big drawdown we saw in 2022. U.S. dollar. This is the back test associated with the dollar, commodities, and then the back test associated with Bitcoin. As you can see, all those crypto winners that we've had have occurred in these bearish macro weather model, sort of bearish macro weather model regimes for crypto. So getting into how the system actually works, what the system does is 2 things. One, it tries to understand what the baseline returns are, baseline levels of volatility are for the asset class. And then it regime segments each of these component features into different regimes, and then backtest the excess returns that are generated by those that correspond to those regimes. And so right now, growth is trending higher. So right now, the backtest that's going for this particular indicator that's being fed into the composite signal for each of those asset classes is this one. Positive excess returns for the stock market, positive excess returns for Bitcoin, positive excess returns for commodities, negative excess returns for the dollar and the bond market. Consensus next 12-month real GDP growth delta, that's negative. So it's feeding this excess return back test to the composite signals in the middle of this page here. Keep it moving here. Headline CPI is trending lower. So it's contributing that excess return back test. The next 12-month, since this next 12-month headline CPI delta is negative, so it's contributing that excess return back test. The unemployment rate is trending higher. It's contributing this excess return back test. The consensus next 12-month unemployment rate delta is positive, so it's contributing this excess return back test. The next 12-month sales growth rate for the S&P is negative. It's been trending lower, so it's contributing this excess return back test. The implied earnings growth rate is trending higher, so it's contributing that excess return back test. Sovereign fiscal balance to nominal GDP ratio trending higher, contributing that excess return back test. U.S. dollar real effective exchange rate trending higher, contributing this excess return back test. And 42 macro net liquidity is trending higher, it's contributing that excess return back test. Global liquidity proxies contributing the rising excess return back test. Domestic borrowed money supply is contributing the decelerating excess return back test, as is the global credit growth back test. Benchmark policy rate is trending sideways, contributing that unchanged back test there. The 2-year nominal yield spread, benchmark policy rate spread is trending lower, so it's contributing that excess return back test. Aggregated dollar positioning is neutral, contributing that excess return back test. Aggregated treasury positioning is bearish, contributing that excess return back test. Aggregated commodities positioning is also bearish, contributing that excess return back test. And then aggregated U.S. equity positioning is neutral, contributing this excess return back test. So the weather model is doing this daily. So while everyone's out there reading Twitter and listening to podcasts, trying to figure out what the hell's going on in positioning, what the hell's going on and with policy rates and where policy rates are headed, trying to figure out what's going on with credit growth, trying to figure out what's going on with liquidity, trying to figure out what's going on with fiscal policy, trying to figure out what's going on with corporate profits, trying to figure out what's going on in the labor market, trying to figure out what's going on with inflation, trying to figure out what's going on in growth. When you string those things together, just know that the macro weather model is already doing that statistical analysis for you in terms of creating real, consistent and accurate signals in terms of the rolling 3-month forward outlook for those asset classes. And again, the macro weather model is not trying to tell you where the stock market is going to be 12 months from now. That's what our fundamental research process is for. It's designed to tell you, what the current, how this is, it's designed to tell you as Mr. Buy-Sider, Mrs. Buy-Sider, what the durability of the current trade is. And if the current trade is undurable, what is the next trade likely to be based on these composite signals and based on our fundamental research process that we just went through?